The COVID-19 pandemic has spread globally, and its impact is being felt through all economies. Current estimates from the IMF show global growth contracting this year by about 2.9%. Economic contractions are expected to be deepest in the second quarter of 2020, with some recovery expected in the third quarter of the year. The strength of the recovery into the fourth quarter and 2021 will depend on how quickly countries are able to open up for economic activity safely, requiring sustainable social distancing rules, safety processes put in place by businesses and public institutions, and capacity of hospitals to accommodate those involved. Current indications from the World Health Organization are that the pandemic is unlikely to end quickly, with shorter, less virulent waves hitting over time. The uncertainties of the crisis have led to extremely high volatility in financial asset prices, with sharp and deep market sell-offs followed by a partial recovery. At this stage, the sustainability of that recovery remains uncertain, and global markets remain in risk-off mode. This has implications for emerging markets and South Africa in particular, as investor appetite for rand-denominated equities and bonds is expected to remain weak. Policy responses to the crisis have generally been robust, with the magnitudes dependent on the degree of policy space available to countries. The US Federal Reserve has taken further steps to expand its balance sheet. The European Central Bank has made similar commitments. Emerging and developing economies generally have less policy space available, and credit is more expensive, and for this reason, the international financial institutions and others have made available extraordinary levels of emergency financial support. The COVID-19 outbreak will have a major health and social impact, and forecasting domestic economic activity presents unprecedented uncertainty. With that in mind, the bank expects GDP in 2020 to contract by 6.1% compared to minus 0.2% expected just 3 weeks ago. GDP is expected to grow by 2.2% in 2021 and by 2.7% in 2022. South Africa's lockdown has been extended by an additional 14 days, bringing the total lockdown period to 35 days. Both the supply and demand effects of this extension reduce growth and deepen it in the short term, as businesses stay shut for longer and households with income spend less. This will likely also increase job losses, with further consequences for aggregate demand. The impact will be particularly severe for small businesses and individuals with earnings in the informal sector. Some factors will support growth, including where businesses are able to open under the current rules, new jobs being created to service more needs under the lockdown, and sustained government spending, both through normal operations and crisis-related spending and programs. The faster the global economy recovers from the crisis, as China appears to be gradually doing now, the more positive growth spillovers will strengthen for South Africa, including healthy price levels for commodity exports. Nonetheless, prices for many commodities have fallen as a result of weaker demand globally. The spot price for Brent crude oil is currently around $31 per barrel, despite an agreement reached by OPEC and other producers to make large oil production cuts. For our forecast, the Brent crude oil is expected to average $42 per barrel in 2020 and $45 per barrel in 2021, very close to the March forecast. As noted earlier, while advanced economies conduct exceptionally accommodative policies, global financing conditions are no longer supportive of emerging market currency and asset values. Credit risk has risen back to 2008 levels, and about $100 billion of local assets have been sold by non-resident investors. The rand has depreciated by 22.6% against the US dollar since January and by 17.3% since the March meeting of the MPC. The implied starting point for the rand forecast is 17 rands 80 cents to the US dollar compared with 15 rands 70 at the time of the previous meeting. Slightly lower oil prices and sharply lower domestic growth pulls down on the inflation forecast. While negative global sentiment and fiscal risks have led to equally aggressive currency depreciation and upside pressure on inflation. The timing and size of these contradictory impulses suggests that they are not perfectly offsetting, with weaker inflation in the near term likely giving way to higher inflation later in the forecast period. The bank's headline consumer price inflation forecast averages 3.6% for 2020, 4.5% for 2021, and 4.4% in 2022. The forecast for core inflation is lower at 3.8% in 2020, 4% in 2021, and 4.2% in 2022. The overall risks to the inflation outlook at this time appear to be to the downside. Electricity pricing remains a concern but has moderated somewhat. Risks to inflation from recent currency depreciation are expected to be muted as pass-through is slow. Global producer price inflation has decelerated. Lower oil prices will reduce petrol prices in the near term. International food prices have eased, and local food price inflation is expected to remain low, in part due to higher domestic production levels. Expectations of future inflation broadly remain around the midpoint of the band, although market-based expectations have recently ticked up in response to the depreciation of the currency. Weaker domestic growth and greater fiscal risks have resulted in a downgrade by Moody's credit rating agency and confirmation of a negative outlook by Fitch. A weaker currency and higher borrowing costs for government, banks, and firms. South Africa's risk profile has increased. Despite this rise in country risk, the committee notes that the more prolonged lockdown and slower recovery creates downside risk to inflation and allows further space for monetary policy to respond to the virus-induced demand shock to the economy. Barring severe and persistent currency and oil shocks, inflation is expected to be well contained, remaining below the midpoint of the target in 2020 and close to the midpoint in 2021. Against this backdrop, the MPC decided to cut the repo rate by 100 basis points. This takes the repo rate to 4.25% per annum, with effect from 15th April 2020. The decision of the MPC was unanimous. The implied path of policy rates over the forecast period generated by the quarterly projection model indicates 5 repo cuts of 25 basis points extending into the first quarter of 2021. Monetary policy can ease financial conditions and improve the resilience of households and firms to the economic implications of COVID-19. In addition to a continued easing of interest rates, the bank has taken steps to ensure adequate liquidity in money and government bond markets, and to ease capital requirements to free capital for on-lending by financial institutions. Each of these steps make more capital available to households and firms. Monetary policy, however, cannot on its own improve the potential growth rate of the economy or reduce fiscal risks. These should be addressed by implementing prudent macroeconomic policies and structural reforms that lower costs generally and increase investment opportunities, potential growth, and job creation. Such steps will further reduce existing constraints on monetary policy and its transmission to lending. Global economic and financial conditions are expected to remain highly volatile for the foreseeable future. In this highly uncertain environment, future decisions will continue to be highly data dependent, sensitive to the balance of risks to the outlook, and will seek to look through temporary price shocks. As usual, the repo rate projection of the QPM remains a broad policy guide which can change from meeting to meeting in response to changing data and risks. That concludes our statement, and we are now going to use this virtual platform. You will have to raise your electronic hand and bring in your question. Please remember, if you are not speaking, to keep your microphone on mute. You can also post the questions through the chat function of the Zoom platform. Are there any questions?
Yes.
Miriam.
Yes, thank you, Governor. I was wondering if you had had a chance to update your budget deficit forecast for the year, which you gave us at the last briefing, and whether you've also updated your expectations for job losses and small business closures.
Any other questions?
Question from Angelo.
Yes, Angelo.
Obviously, this was an emergency meeting. Are you planning to shorten the time between meetings going forward, and what's going to be your criteria to change?
Okay, somebody says he has raised his electronic hand, and the question says, from Mail and Guardian, what does the Reserve Bank say about the suggestion that it should print money to finance fiscal deficit? Okay. And then Jan Cronje from Fin24 says, why was the cut broadcast ahead of the address? Thank you. Okay, thank you very much, Miriam. The MPC and the MPR are two different platforms. The MPR goes back and reviews what has actually taken place. We were not presenting a budget deficit forecast. All that we did at the time was that, given what has happened to the economy and what we have seen since the lockdown, that we think that is where the deficit could come out at. As a general principle, we do not spend time projecting what the deficit is going to be. In normal times, we just take the figure that is published by the Treasury, and that fits in for us to assess what the fiscal impulse is. Job losses update, as we have stated, is a nightmare for forecasters at the moment. And anybody who comes with a number now about what the job losses would be, they are most likely going to be a thumbs up, because we do not know at the end of this lockout, when the reset button gets pressed and who starts first, which industry starts first, and I wouldn't hazard into trying to do that. Angelo, the question of whether we would shorten the meetings, no, we still have the meeting in May. We have got our schedule going forward. Why did we have this meeting? Lots of things changed since the March meeting. When we had the March meeting, yes, COVID-19 was here. We didn't know that there was going to be a lockdown. Then there was the lockdown, and we were busy assessing the effects of the lockdown. Whilst we were assessing the effects of the lockdown got extended last week, Thursday. And so we spent the weekend, the whole long weekend, the good men and women at the SARB didn't have Easter weekend. They spent the whole Easter weekend trying to figure out what this means for the economy and thus what should the response of the monetary authority should be. So the big change circumstances was the lockout, which also later got extended. For now, we still have our schedule of the MPC meeting. Jan Klonye, why was the cut announced before the address? It's a very simple thing. If we said that the SARB is calling a press conference, there would have been speculation about what we are going to do at that press conference. And what we have done is quite consistent with what other central banks during times like this have done, which is make the announcement and say, if you want to understand the rationale behind the policy adjustment that we have taken, you are welcome to join us at the press conference. Why was it on Twitter? And there seemed to have been a problem on the website. The sequencing is that it normally goes on a website first before it goes into the social media. But this thing was broadcast at the same time, and the website was slow picking it up. That's a technical glitch that we could always deal with. Main and Guardian, what's our response to the printing of money to the financing of deficits? Basically, let's just go back to basics. The South African government does not have a problem financing its deficit. The South African financial markets are deep and liquid and could meet the financing requirements of the South African government. We did, however, when we saw that there was a dislocation in the secondary market, decided that we would provide liquidity so that the financial market continues to function, so that the South African government could continue to finance itself and all the other issuers in the South African market who use the bond market could continue to finance themselves. We also did this because the manner in which our repo rate system works is that it works on a collateral basis. And the collateral that we take at the SARB is in the form of government bonds. Now, when you take collateral, you better know what the value of that collateral is. And if there is a dislocation in the market, that means it is difficult to price the collateral. And that is why the Reserve Bank got involved in the secondary market. I need to clear these things. So that is in the secondary market. Monetization of the deficit, you said printing of money. The South African Reserve Bank Act does place a limit to what the South African Reserve Bank can do in the primary market. There is a formula there that sets out the limit that is based on the outstanding liabilities of the Reserve Bank, beyond which we cannot participate in the primary market, which is where the government funds itself. The idea that you are talking about of printing money, which is basically that the South African Reserve Bank could just print money and give it over to the South African government at zero interest, and then the South African government can then go and spend the money as it pleases. It would not take very long before there is too much money in the economy chasing too few goods. And when you have too much money chasing too few goods, you will be faced with a situation where prices begin to rise. Understand that the banknotes and coins that you have in your pocket are just but a piece of paper or a piece of metal. The only thing that gives them value is that there is a central bank that is prepared to stand behind those notes and coins and make sure that they are able to pay roughly the same amount of goods and services in the future as it is buying today. Put simply, the mandate of the Reserve Bank is to contain inflation, and measures like deficit financing through the printing of money are not in accordance with what the South African Reserve Bank is actually tasked to do. So, let's just round this thing up. South Africa has got a functioning financial market. The South African government can finance itself there. The South African Reserve Bank has got a responsibility to ensure that financial markets function properly so that all other issuers can continue to use those financial markets. And thirdly, that to ensure that our repo system works and that collateral is adequately priced, it is in the interest of the SARB to have a functioning financial market. There are other questions posted there from Funeko. Was the driver of high economic growth in 2021 and 2022 the risk up or on the downside? What consideration to further? Somebody had typed in quickly whilst I was reading. Chris, this is going to be your question, my friend. Chris, can you deal with that growth question?
Yeah. Yes, sure. Just reading it quickly. Well, we didn't consider any further credit rating downgrades on the growth forecast. The drivers of higher growth in 2021 and 2022 are essentially the normal recovery in the economy. So we have consumption, spending, investment, and exports all normalizing to some extent, although we've dampened down the recovery quite a lot relative to what it could be. So it's not really a V-shaped recovery. It's much more of a prolonged, gradual recovery. Are the risks to the upside or the downside? Look, that's really hard to tell. I think the level of uncertainty out there is just so high. A lot really depends on what the global economy does. So if we see big advanced economies coming out of their own periods of lockdown relatively quickly and economic activity picking up quickly, then we would have to pencil in a kind of V-shaped recovery for the globe, and that would have a big impact on South Africa's own recovery, the shape of it. But if there are repeated waves of pandemics and economies go through cycles of lockdowns over time, then that recovery is going to be very, very muted indeed. And so, we, alongside lots of other people, are watching very closely to see how China's recovery goes. So, and that recovery has been relatively modest and moderate. So, I think at this stage, our expectation is that that's likely to happen throughout the global economy and then feed through into our own numbers. So we have a recovery, but a lot of that statistical bounce back that occurs when households and businesses start to come on stream. We make some assumptions about the pace at which that happens, but most of that that kind of gradual normalization happens into the third, fourth quarter, first quarter of 2021, and so. Those numbers might look quite optimistic, but they're fairly modest, actually.
Okay, Fundi, can you deal with the question about whether we are concerned about negative real interest rates? If you could deal with that, and Rashad, can you deal with the QPM question? And then there is a question from Likanyo about liquidity in the financial markets. Fundi, that sounds like it has got your name written all over it. And then there's a question from Fifi about the IMFC. We will deal with that at the end of the MPC questions.
Thank you all. Let me start with the liquidity question from Lucanio. And then I just might need to be reminded on who asked the question on the negative real interest rates. So on the liquidity questions, certainly we have seen, and that's also the feedback that we've received from market participants, that the measures that we've put in place to manage liquidity are working. And we continue to monitor on a daily basis and also during the course of the day whether there are signs of market stress, and so far we haven't seen much. We are continuing with our bond purchase program on a daily basis, so that also is moving along. And we would be monitoring, I guess, and if we were to see any signs of stress, we would take appropriate action as the SARB in terms of the measures that we have announced. We run weekly auctions, and our weekly repo auctions have been for a term repo of 1 week and 3 months. And we continue to communicate with market participants as to whether the term that we're providing is sufficient. And we continue that conversation with them on a weekly basis. Okay. Lucanio, if I look at your question, you also want to know about the risk that government might struggle to finance through financial markets. When we are putting in place a liquidity management strategy as the SARB, we are not looking at the cost of financing by government, given the levels of the bond yields. We just seek to ensure that there are sufficient buyers and sellers in the government bond market so that the market can function. And there are things that, of course, government itself is aware of that has to be done. And there are things that they monitor in the way that they run their auctions on a weekly basis as well. So we continue to liaise with them on that issue. Okay, can I get a reminder as to who asked the question on the negative rates? I didn't see that. Right, I see it's from Ed. Okay, so the question is the SARB concerned about the prospect of negative real interest rates? We're not there yet, Ed. So I think that the primary driver for the MPC decision is about what is happening to inflation and what the inflation fundamentals look like. And we have said that at the moment, and if you will see the data that we will publish later on, that our assessment at the moment is we're still in the realm of positive real interest rates. And one would have to see what is happening to inflation and what action that requires from us as the SARB. So far, we are still in the territory of positive real interest rates, and we are taking the action that we think is appropriate to respond to inflation as the MPC. I think that's where I will leave my comments for now.
Thank you very much. Let me just say something quickly about the QPMI. I'm struggling to read the chats on my Zoom, but I'll give you a sense of what I think the question was. I mean, we have these pace of 250 basis point zero cuts and then a 25 basis point zero cut. Essentially, what we've done is we've front loaded it. We've decided on 100 basis points. And I think that the key thing now is that when we re-estimate or recalibrate the model, we will then look at what the model says given our new parameters. So for all intents and purposes, although as was the case in the previous meeting, is the model recommended a pace of cuts over a period of time, 75 basis points. We decided given the circumstances to cut 100 basis points. We now in a new round with new estimates, particularly a massive decrease in our output gap, increase in output gap and decrease in our growth for 2021, and that has taken us to a particular path. In fact, if you extend the model, that path could also kind of move to the other direction. It could call for tightening later on in the process. But I'm not sure about the specifics of the question. Thank you.
Thank you very much. Are there any other questions?
Several on the chat.
Hilary, I didn't see your question on the chat.
Okay, may I ask them in person?
Yes.
I had two. The one is, if you look at the path of what you see is the path of inflation and of growth, with inflation and growth expected to pick up next year, would those be signals for interest rates to rise again? When you say you're data dependent, would the data suggest that interest rates could again have to be raised once inflation and growth start to pick up next year? That's my first question. And the second question is, we know that a credit guarantee scheme or a funding for lending scheme of some sort is being discussed by the Treasury, by the SARB, by the banks to back to let the banks go further to back companies. Would such a scheme have any monetary policy implications or regulatory implications? Thanks.
So, Lisecha, can I jump in on the first part of that question?
Yeah.
I tried to answer it in the chat there. Look, the real rate is meant to be a forward-looking rate. So if you take inflation 4 quarters ahead, the current repo rate generates a negative real rate. Over time, as inflation comes back, that real rate is going to narrow a bit. And so it's that kind of change in the real repo rate over time that we have to watch. So next year, if the nominal repo rate is still sitting at 4.25%, but inflation is expected to be closer to 5% or 4.5%, then that's going to generate a large real negative rate, probably at a time when we're less keen on seeing that happen because the economy is well into recovery. So it's that trajectory of the real rate on a forward-looking basis that we need to monitor. But a lot will obviously depend on whether or not those growth and inflation projections transpire. Thanks.
Okay, thanks, Chris. Hilary, the thing about guarantee scheme and the world over, when we have seen this, whether they are in the US or in the UK or wherever, there are treasuries behind them. So that question is best answered by the treasury than by the Reserve Bank. You did though raise a question about what would the monetary policy effects of such a scheme be? We don't know. We have not. There are, you know, one of the things I had learned over the past 3 weeks is that there isn't a shortage of ideas coming up in South Africa. Some of them useful, others outrightly ridiculous, some of them bordering on recklessness. And for policymakers, what has to be done is to constantly to distill these things and see what is viable proposition and what is not. And for us to assess what the monetary policy effect of any of these schemes, we must first see what the details of the scheme are. We, from where we are as the central bank, I need to state, this COVID-19 has been both a supply and a demand side shock. The ability of the monetary authorities in this space is really to deal with the demand side shock, hence the adjustments in the policy rate. And so what we have actually then seen is that as a central bank, we look at our entire range of tools and we would deploy our tools as appropriate in accordance with our mandate to cushion the South African economy from this shock. That's what a central bank can do. Many of these schemes which have got spending decisions, we must understand. Central bankers as technocrats do not have the ability, neither do they have the authority to make spending decisions. In our constitutional setup, spending decisions are the preserve of the publicly elected officials, publicly elected representatives of the people of South Africa. And those decisions are best made there rather than by technocrats in a central bank. I think that deals with all the questions. If you had posted a question and we didn't respond to it, you are welcome to post it in person before we close the conference. Okay, there aren't any other indications. Thank you very much for your understanding and your participation in this press conference. This conference is adjourned. Thank you.